The money in your bank account is actually not real in the way most people think. This is not a metaphor and not a conspiracy idea. If everybody went to the bank tomorrow and tried to take all their money, the whole system would fall down in a few hours because the cash simply does not exist. This is not a mistake. It is how the modern financial system is built. It is a very old trick, and after hundreds of years, we just accepted it like it is normal. Today, we call it fractional banking, and it works behind global debt, inflation, and the feeling that everybody is richer than they really are. To understand how this started, we have to go back before apps and digital money. In medieval times, people used gold and silver as money. If someone was rich, they had real coins at home or jewels they could sell. But walking around with gold was dangerous. So people started to leave their gold with goldsmiths because they had safe vaults. The goldsmith gave them a paper note saying they can return and take their gold anytime. After a while, people understood they can use these notes for trading, since the paper had the same value and was much easier to carry. This is where the trick began. Goldsmith saw that people almost never came all together to take their gold back. If they had 100 customers, maybe only one or two needed gold in a week. That means most of the gold stayed in the vault. So goldsmiths got clever and started to write more notes than the gold they had. For example, if they had 1,000 gold coins, they gave notes equal to 2,000 coins, and they charged interest for these extra notes. Nobody noticed as long as everybody did not come at the same moment. Basically, they created money from nothing. Later, this idea became a real banking system. By the 17th century, even governments used this method. The Bank of England was created in 1694 because the government had huge debts from wars and needed money. The bank gave loans to the government much bigger than their real gold reserve. And the government paid back these loans with taxes from regular people. If this sounds familiar, it is because countries still do this today. They borrow money that does not exist, and future generations pay the bill. The United States followed the same road. Early banks printed notes that could be exchanged for gold, but soon they realized they can print more notes than the gold they had. Sometimes people panicked and ran to the bank to take their gold, and the banks collapsed because the gold was not there. Instead of removing this system, governments made it stronger. They created central banks to support commercial banks and keep the public believing everything is fine. Let's look at how it works today. If you go to the bank and put $100 there, you think the bank keeps your money safe. Actually, the bank keeps only a very small part of it. In the past, the bank needed to keep maybe 10%, so they kept $10 and loaned 90. Someone else spends that 90, it gets deposited again, and the cycle continues. Your $100 can turn into almost $1,000 in the economy, even if only $10 exists as real cash. The rest is debt. But even this old rule is gone now. Since March 2020, banks in the US have zero reserve requirement. They do not have to keep anything. So what limits lending today is not reserves, but capital rules written by international regulators in Basel. These rules say banks need enough of their own money to cover risky loans, and they need enough liquid assets like cash or government bonds to survive a short crisis. If they want to lend $100 for a risky loan, they may need to keep $8 of their own capital. That is the real limit, not customer deposits. Also, banks do not use deposits to lend anymore. It is the opposite. When a bank gives you a loan, it creates new money at that moment. It does not take cash from a vault. It just writes the amount into your account. And now this money exists because you promised to pay it back. More than 90% of money today is this type of bank-created money, not physical money from the central bank. This brings three big results. First is inflation because the total money keeps growing faster than real goods. Second is never-ending debt because new money is born as a loan and must be paid back with interest. Third is power concentrated in banks and governments because they create and control most of the money flow. Rich people with real assets become richer when prices rise, but normal people lose buying power. When people lose trust, the system collapses. It happened in the Great Depression in 1929 and again in 2008 during the housing crisis. Both times the problem was the same. There were more promises than real value, and when people started to panic, the illusion broke. Governments stepped in and gave huge amounts of money to keep the system alive, because without this system, the economy stops. Different countries use different tools. In the US and Europe, reserve requirements are basically zero. Emerging countries like China or India still use higher reserve requirements, but Basel rules still control risk everywhere. No matter where you live, the real control of money creation happens in Basel. Here is the uncomfortable truth. The system cannot work if everybody pays their debt. If all loans were paid tomorrow, the money supply would fall and the economy would stop. The system needs you to borrow and spend, because that is how new money enters the world. You are part of the machine, both as a customer and as the person who carries the risk. So what does this mean for you? First, money in the bank is not real wealth. Real wealth is land skills, knowledge, tools, and things that keep value even during crisis. Second, debt is not just a personal choice. It is a base element of the system, and it works mostly for lenders, not for borrowers. Third, inflation is not an accident. It is part of the design, so you have to run faster every year to stay in the same place. This does not mean the world will end, but it means you should understand the system. Saving cash in a bank will not protect you. Believing the system blindly will not help you. You need to build real assets and understand how the game is played if you want financial independence. History shows the same story again and again, from medieval goldsmiths to bank runs to the 2008 crash. Every time the problem is promises larger than reality and people losing trust. The next crisis will also follow the same pattern because the system depends on confidence more than anything else. So next time you look at your bank balance, remember that most of it is just numbers created by debt and rules written far away from your daily life. When you understand this trick, you can start to protect yourself. If you ignore it, you keep playing a game where the house always wins. If this changed your perspective, you can subscribe. History can explain a lot, and I try to show where to look.